If you're still thinking this is a normal silver rally, you're about to get emotionally blindsided. Because what's happening right now isn't price discovery. It's a supply chain screaming through a chart. And if the next few sessions go the way the market is set up to go, people are going to wake up to a number they were trained to believe could never print. $100. This week, before we go any further, this is not financial advice. This is a market breakdown, the plumbing, the mechanics, and the psychology, so you can understand what a parabolic move actually is when it shows up. Now, let me tell you why the analyst crying part is not a meme. It's a pattern. You've seen analysts do this for years. They act brave when a commodity is calm, and they act offended when a commodity turns into a stampede. When silver is quiet, they call it dead money. When silver moves, they call it irrational. When silver goes vertical, they call you lucky. But the truth is simpler. Parabolic moves don't start when retail gets excited. They start when the professionals lose control of time, not price. Time. Because in commodities, time is delivery. Time is inventory. Time is the difference between I can get it next week and I can't get it at any price. And once time breaks, price goes nonlinear. So here's the promise of this video. By the end, you'll understand three things. What parabolic actually means in a physical market. The chain reaction that can launch silver from 60-something to 3 digits faster than anyone thinks. The telltale signs that separate a normal spike from a structural repricing. And then I'm going to end with the one question that matters. Are we watching a temporary squeeze? Or the moment silver stops behaving like a commodity and starts behaving like allocation? Let's start with the first uncomfortable truth. Part 1. The price is not the story. Availability is. Most people think markets are ruled by the chart. In reality, markets are ruled by the warehouse. Silver is not a software stock. You cannot print more supply with a press release. You cannot scale mining output in a quarter. You cannot teleport bars across the planet on demand without friction. So when demand surges, the market has only 3 ways to respond. Raise price to ration demand, pull inventory forward from the future, or quietly switch from market to allocation. And the terrifying part is this. Allocation can begin without an announcement. It begins with little symptoms. A dealer says 2-week delay. A refinery says, we're prioritizing contracts. A wholesaler says minimum order size is higher. A buyer says, I'll pay the premium, just confirm delivery. A bank says, cash, settle. And suddenly, the metal exists, but the availability is conditional. That is the exact moment parabolic moves are born, because the chart isn't just reflecting buying. It's reflecting fear of not getting it. And fear buys harder than logic. Part 2, why $100 can happen faster than people think. Let's talk about the number everyone argues about. Is $100 possible? Sure, but possible is not the question. The question is, can it happen quickly? And the answer is, in the right setup, yes. Here's the setup. A parabolic move is not one big buyer. It's not one headline. It's not one event. It's a chain reaction, where every link forces the next link to act faster. I call it the 5 doors. Door 1, industrial buyers don't stop. Door 2, paper shorts get trapped. Door 3, the physical premium breaks the illusion. Door 4, margin calls force chaos buying. Door 5, everyone learns the lesson at the same time. If 2 doors open, you get a strong rally. If 3 doors open, you get a squeeze. If 4 doors open, you get panic. If all 5 open, you get a parabola. Let's walk through them. Door 1, industrial buyers don't care about your chart. Industrial demand is not emotional. It's contractual. If you build solar, electronics, medical devices, EV components, grid equipment, you don't buy silver because it's cheap. You buy silver because it's required. That means when price rises, they can't always wait. They can delay, substitute, redesign, but those are slow. In the short run, they pay up. Because failing to deliver products costs more than paying a higher input. So in a parabolic phase, industry becomes the sticky buyer. They don't chase for thrill. They chase for survival. And that's when the market learns a brutal truth. Demand is not as elastic as the spreadsheet said. Door 2 shorts are not just bets. They are obligations. Now we talk about the part that makes people uncomfortable. A short position in a commodity is not like shorting a stock for a trade. In metals, especially when leverage is high, shorts are often part of a system. Hedging, market making, carry trades, inventory financing, structured products, and promises built on the assumption of liquidity. When the market is calm, that system looks elegant. When the market becomes stressed, it becomes a trap. Because a short is not, I think it will go down. A short is, I owe metal later. And if the metal becomes hard to source, the later becomes the problem. If enough shorts try to cover at the same time, they don't just push price up. They force the market to reveal how much metal is actually movable. And if that movable pool is smaller than the paper pool, you get a squeeze. Door 3, the physical premium is the real price. Here's a line I want you to remember. Spot is a headline. Premium is the confession. When the market is healthy, premiums are boring. When the market is stressed, premiums become the true message. Because the premium is what someone pays to get delivery now. So in a parabolic move, you see a strange divergence. The chart looks wild, but the physical market looks even wilder. Bars vanish, dealers ration, wait times stretch, bid-ask spreads widen, and the loudest sound in the room becomes, can you actually deliver? And once that question spreads, people stop buying silver as an investment. They start buying silver as insurance against denial. Door 4 margin calls turn logic off. Now we hit the accelerator. When price moves fast, it triggers margin calls in leverage positions. That creates forced buying, not emotional buying, mechanical buying. And mechanical buying is the engine of a parabola because margin calls don't ask, is this too expensive? They ask, do you have the collateral? If the answer is no, positions are closed automatically. That closing can be buying. And once it starts, it can feed on itself. Higher price, more margin stress, more force action, higher price. That's the loop. Door 5. The crowd learns the same lesson at the same time. This is the final door. And it's psychological. Most people don't buy early. They buy when the narrative becomes undeniable. They buy when their friend texts them. They buy when mainstream clips start circulating. They buy when the number gets so big, it feels like a cultural event. But here's the twist. In a parabolic move, the late crowd doesn't just show up. They collide with a physical market that can't absorb them. And that's when you get price gaps, limit moves, weekend panic, cash settlement rumors, emergency margin adjustments. And yes, analysts who spent years calling silver boring, suddenly looking like they're about to cry on TV because their models assume smoothness. Parabolas are the death of smoothness. Part 3, why this week matters. Now, I'm not telling you silver will hit $100 this week. I'm telling you the market can travel farther in 5 sessions than people emotionally understand. Because when a commodity turns into a confidence event, it stops trading like a line. It trades like a door slamming. What matters this week is not the exact number. What matters is whether the market starts acting like delivery is scarce, shorts are trapped, and the only safe position is owned metal, no counterparty. If those conditions hold, the market can move in steps, not increments. And that's how you go from that's impossible to it happened overnight. Part 4, the analyst crying moment. What it looks like. Let me paint the scene. Price is running. Every pullback is bought in minutes. People are refreshing charts like it's oxygen. And then an analyst goes on camera and says something like, this move is disconnected from fundamentals. That's the tell, because in a parabolic phase, the fundamental is not a spreadsheet. The fundamental is scarcity of deliverable supply. Then you'll hear, we expect a retracement. Maybe, but notice the tone. They're not analyzing anymore. They're pleading, because parabolas humiliate forecasters. They punish certainty. They punish arrogance. They punish anyone who thought a commodity must behave politely. And if you've lived through any historic commodity squeeze, you know the script. First, they dismiss it. Then they rationalize it. Then they get angry at it. Then they beg it to stop. Then they rewrite history and claim they saw it coming. Part 5. The 3 signals that the parabolic move has started. Okay, practical time. If you want to know whether a parabola is starting, watch 3 things. Signal 1, pullbacks stop giving you time. In normal markets, pullbacks breathe. In parabolas, pullbacks are swallowed. Signal 2, premiums and delays accelerate, not in one dealer, across the chain. Signal 3, cash settlement language increases. Any sign that the system wants to settle in paper when you thought you bought metal, because that's the moment the market admits stress. If you see all 3, then you're not watching a normal rally. You're watching a liquidity event. And in metals, liquidity events go vertical. Part 6, the parabolic move is not about greed. It's about fear. People think parabolic moves are greed. Wrong. Greed is slow. Greed is calculated. Greed says, I'll buy on a dip. Fear is fast. Fear says, I need it now. And the most powerful fear in commodities is not, what if it goes up? It's, what if I can't get it at all? That fear turns every buyer into a front runner. They don't want the best price. They want priority. And priority is not a market concept. Priority is allocation. Part 7, how $100 happens. The fast path versus the slow path. Let's split the world into 2 paths. Slow path. Silver grinds higher. It consolidates. It builds a base. The market adjusts. Supply slowly responds. Demand slowly adapts. That's the rational path. Fast path. A trigger hits a market already tight. Shorts scramble. Premiums spike. Inventory is pulled forward. Margin calls cascade. And price leaps gaps. That's the parabolic path. If you want to understand why $100 can print quickly, it's not because everyone decided it's worth $100. It's because the market temporarily loses the ability to supply now. And when now becomes scarce, price becomes a weapon. Part 8, what you should do with this information without hype. I'm going to be responsible here. The goal is not to hype you. The goal is to keep you from being psychologically manipulated by volatility. Here's the rule. In parabolic markets, your biggest risk is not being wrong. Your biggest risk is being forced to make a decision in a hurry. So decide your framework before the market forces it. Ask yourself, am I trading price or owning metal? Do I care about delivery or just exposure? What is my time horizon? What would make me panic? What would make me reckless? Because the market's job in a parabola is to destroy your emotional timing. If you have no plan, you become liquidity for someone else. Part 9, the end game. What parabolas usually do. Most parabolic moves end one of 2 ways. They blow off violent top, brutal pullback. They reprice a new plateau forms because the world learned something structural. Which one happens depends on the cause. If the cause is purely speculative, it blows off. If the cause is structural scarcity plus financial leverage, it can reprice. That's the difference between a meme and a regime change. And the reason silver scares people is because it can be both. Silver is a monetary metal with industrial constraints. That combination is rare. It means you can get a story that starts with manufacturing and ends with psychology. Part 10, the last line. The question nobody wants to ask. Let me end where we began. If silver hits $100 this week, it will not be because everyone suddenly became smart. It will be because the system got squeezed on time. And when the system gets squeezed on time, it reveals something darker. That the market was more leveraged than it looked. That the supply was more conditional than it sounded. That the liquidity was more illusion than fact. So here's my question to you. Do you think this move gets fixed by higher price? Or do you think we're watching the early stages of a new era where silver stops being something you speculate on and becomes something you secure? If you want part 2 of this breakdown, I'll do it, but only if you tell me in the comments. What would convince you this is real? A price level? A premium level? A delivery delay, a policy change, drop it below. And if you want to stay ahead of the next impossible print, subscribe. Because in markets like this, the most expensive mistake is thinking you have time.